Get, set, go. So like you always say before a sprint, on your marks, get, set and go. And it's a flat start with just no bias per se actually for the market, just no bias. 1% here or there for the Nifty, 1 point actually. 1 point here or there for the Nifty. Similarly, same thing can also be attributed for the small cap index and for the mid cap. The breadth is looking powerful, but I would wait for the breadth actually to settle down before you come up with any kind of very meaningful number per se. Advanced decline positive. Let's look at some newsmakers. Last week the big newsmaker was GMR. On Friday it was a newsmaker. 5-star was a newsmaker. Gale has been in the news per se. These are 3 large newsmakers you want to see. Now let's look at individual names here. HDFC Bank, Kotak, ICICI Bank, and to a large extent Axis Bank. Is there inertia in some of the large cap banks? Are they picking bait from where they left last week? And the answer to that is well, they're taking it easy. The breadth I think is still the talking point, and the brokerage impact on stocks like Oberoi Realty and Saregama I think is visible. So it's a thanda start, Aisha. Nothing large, nothing meaningful, unexpected lines. Markets are simply consolidating.
Yeah, consolidating some more, but let's take a look at some of the individual stocks which are in focus. You just flagged off GMR Airports. There's also GMR Power. Some of the newspapers are reporting that they perhaps may be in talks with some of the infra-focused and sovereign wealth funds to raise some amount of cash. 5% higher for GMR Power as we speak right now. The other stocks in focus this morning, and there's Subros as well. They've already bagged a 25 crore rupee order from Railways for ACs. The government, remember, has made AC cabins mandatory. 13% gap up coming in on Subros this morning. Masgao, and we're going to be chatting with the management as well shortly on the show. They've bagged an order worth about 1145 crore rupees from ONGC, so look out for that as well. And Tata Motors too, which is going to be increasing the price of its CVs up to about 3% from January 1st next year. So that's another stock which is in focus. There's DRL as well. We already told you about the news flow, and brokerages like Antique are now saying that US FD observations for their Bachupalli unit can actually lead to a warning letter. DRL has gapped down. 6.5% is the kind of cut that you're on DRL alone. There's Cipla as well, wherein one of their subsidiaries has voluntarily recalled one lot of one of their seizure drugs. So look out for what that stock as well does in trade this morning. Just a bunch of other names. There's Cyient, like we told you. The management meet takeaways indicate that they are targeting a revenue CAGR of 10 to 20% over the next 3 to 5 years. Cyient has made a decent move, about 2% higher or so. And Max Healthcare, we just flagged off this stock for you. They've acquired a hospital in Lucknow, so look out for that. Max Healthcare starts off absolutely flat in trade. There's MedPlus as well, wherein their subsidiary has received orders from the DGCA, or rather DCA, for suspension of drug license for about 7 days. MedPlus will just come up on your screens, not really seeing any material impact. Aditya Vision, MK has initiated a buy with a target price of 5,000 rupees per share on this one. So that's another stock in focus. But REC, Z, India Cements, RBL Bank, the momentum movers from last week. Let's check in on those. They continue to hold higher. Some more momentum for REC, flat for Z right now. RBL Bank, still further up move, almost a 2% bump up after a 4.5% traction coming in on Friday alone. Kunal, flat for the index, lot of individual stock action. What trades are you executing?
Yeah, so I think the mid caps today are looking a bit more charged up as compared to the large caps. So we'll see whether this is a trend in the making for the rest of the day, or it's just a partial trend for the start. In terms of the opening trade, Infosys is something which I'll be bullish on. We flagged off TCS earlier. Even Infosys, given that breakout above 1500 mark, looks attractive for a buy at current levels.
All right, sticking with large cap IT. What about you, Naresh? What's the trend that you're observing, and what's your first trade?
So, continue like the banking space. So, ICICI Bank is one which can break out, and IndusInd is another. So, like ICICI Bank for a breakout move for the next few sessions.
Well, it gives me great pleasure now to bring on board Jonathan Garner, Chief Asia Emerging Market Strategist with Morgan Stanley. Jonathan, good morning. Thank you for joining us. Jonathan, if I refer to your last notes available in the public domain, your note in the month of November, you are overweight India. However, you feel that the H1 first half could be challenging one for emerging markets. Could you like to elaborate more on that?
Yes, thanks for having me on. So India is our largest overweight. It's a market that we have preferred over the last 2+ years, and we're certainly going into 2024 bullish. I think the rationale for that is superior GDP growth, nominal GDP growth of probably 12 or 13% over the next couple of years, and superior earnings per share growth. If you go back to early 2021, so I guess sort of 3 years ago, India's earnings per share have compounded to the extent of 60% in US dollar terms. That compares with essentially zero for overall emerging markets and minus 20% for China. And so this ability of Indian companies to deliver sustained earnings growth is extremely important for our bullish recommendation on the market.
Jonathan, given that we are at the peak of the interest rate cycle in US and the US 10-year, which is the most important indicator of which way flows would move, if the 10-year paper peaks out closer to 5 or 5.25, what implications do you think that will have for emerging markets in 2024?
Well, we think US 10-year yields have already peaked for this cycle, and they've started to fall. The disinflationary process gets going globally. What's remarkable about India is, compared to previous Fed cycles, how well India did, which is testament to a much improved current account and fiscal position. So we had very limited volatility in the exchange rate for India throughout the Fed hike cycle compared to what we've seen historically. As the Fed begins to cut interest rates by the mid-year of next year, we would expect the RBI to be broadly following the same pattern of interest rate reduction, not dramatic interest rate reduction, but that will be somewhat supportive to the equity market. But I want to emphasize monetary policy here, either overseas or in India, is not as important as GDP growth and earnings growth.
Jonathan, what is your understanding of India positioning by global investors? If the script moves as per what you've indicated in terms of GDP growth and in terms of earnings growth, do you think India actually could move from neutral to overweight positioning in 24?
Well, India is outperforming so strongly that many clients are chasing a moving target as India's weight in the EM index is rising significantly. At the moment, they're broadly neutral versus that rising benchmark weight. That's within the specialist EM and Asia ex-Japan universe. But what we are seeing is global investors starting to move into the Indian market for the first time. And that's really following the FDI and portfolio equity flows, which are also far more significant than in the past into India. So that's an exciting new development, truly global equity funds starting to add exposure to India.
So Jonathan, for a global asset allocator, if I may paint the picture is go towards China, which is cheap and has underperformed but has underlying risk, or go to India, which is where growth is visible, earnings are decent, but it is also trading above its historical averages. Do you think it's a bit of a conundrum and a lot of dilemma for global investors now to choose between India and China?
Well, our view is quite clear. We strongly prefer India to China. We expect Chinese nominal GDP growth to be less than half that of India next year, to disappoint consensus again, below 5%. We actually are starting to see the currency becoming more volatile. And the ability of China to generate compound earnings per share growth is quite limited. Corporate return on equity has been falling relative to India and other emerging markets for some time. So we would not recommend a contrarian shift back towards China. We would stay overweight India, and we think India will outperform China for a fourth straight year next year, which is unprecedented.
Jonathan, I'm not drawing you toward what the importance of election cycle is. I know Morgan Stanley does not comment on election cycle, but purely in terms of understanding the flows here, do you think if there is a strong verdict which markets like, the flows into a market like India post the central election cycle will actually increase?
Well, we don't comment on elections, as you mentioned. Our Sensex target is 74,000 currently. We think that's relatively easily achievable. Obviously, we'll watch what happens during the election process, and in particular, look at the policy framework. But beyond that, I can't make any comment.
Jonathan, what to your mind will be the biggest moving part for 2024? And just to give a backgrounder for the benefit of our viewers, the biggest moving part in 2022 and 23 was US interest rate cycle. It was geopolitical issues. It was uptick in inflation. What to your mind are the big moving parts for 2024?
Well, all of those are of interest, but again, they're not as important as underlying economic growth. So if you look at India or indeed Japan, that we also favor within our coverage, what's happened is a strong nominal GDP growth story has emerged in both India and Japan, domestically driven. A virtuous circle exists with that, corporate earnings, return on equity, and increased interest in the stock market. And that is ultimately far more important than things like the US Federal Reserve cycle for the performance of equities. And we expect both those two large markets in Asia to outperform again next year. And it's part of what we call a new era in Asian investing, led at one end of the GDP per capita spectrum by Japan and at the other end by India.
Jonathan, if one has to use the recent drop in the US 10-year paper and the decline in crude as a benchmark, is that a canary in a coal mine which is telling us 2024 we could have recession in developed markets? Is that a fear? Is that a valid fear?
That's not our base case view. We do think, however, that US growth is slowing currently, and that goes back to what we said earlier in this interview about the peak for US 10-year yields is probably now lies behind us. For India, lower oil prices traditionally help in relation to the balance of payments. And remember that though there are some sectors in India that have exposure to the US economic cycle, India as a whole is a market where the earnings are much more driven by domestic growth. And within the Indian market, we strongly prefer financials, that you were talking about on your show earlier on. Had a good week last week, and we also prefer industrials, domestic industrials, and domestic consumer discretionary. So we are very focused on domestic India growth within our recommendations.
What is your understanding of the earnings cycle curve in India? At what stage the earnings cycle is? Let's say if the earnings cycle started in 2021 post the COVID flush out, at what stage the earnings cycle currently is in?
Obviously, we work closely with our colleague Ridham Desai and his team in India. I would say that we're at the most midway through, and that it's probably a long earnings cycle this time around. Remember that in terms of thinking about long waves, the scale of foreign direct investment and private equity commitment in India is unprecedented, and that's driving an improved quality of growth and sustainability of economic growth. So it's probably a long earnings upcycle that we're looking at here.
Jonathan, if I take a leaf out of your answer, you said that if you have to prioritize, you would prioritize GDP growth and earnings to understand the future return of a country. But where does valuation fit in? When you have to map a country, you have to look at GDP growth, valuations, and earnings growth. Where does India fit in, both in terms of relative and absolute valuations?
Well, we always think in valuation terms relative to the return on equity and the earnings growth. And so, yes, India is on a growth multiple, if you want to put it that way. Depending on how far out you look, it's probably high teens forward PE on a 2-year forward basis. But that's not a particular problem with the scale of earnings per share growth that we've been talking about. As I said, in dollar terms, compounding, closer to 20% over the last 2 to 3 years. And so we are quite relaxed about that, both in absolute and relative terms.
There are a lot of things which would be at play, Jonathan, in 2024 for India. Again, at the risk of repeating myself, I'm using the word elections for the benefit of our viewers, but there's also a bond inclusion which will happen after JP Morgan. There also would be a lot of other such factors which would be at play. So do you think 2024, in a sense, the stars are aligned for Indian economy and Indian markets? If things go in the right way, they can just be the breakout market?
Well, as I say, we've been consistently overweight India with a few kind of interruptions along the way, but the outlook is very bullish. It is part of this new era of Asian investing that we've written a lot about, and it's one of our key overweights for next year.
Maybe I'm trying to get some exciting word from you, Jonathan. You'll appreciate that being a television commentator. I'm just trying to get one more word apart from overweight from you. So, Jonathan, when it comes to your priority towards financials and domestic denominated, sectors, What about global denominated sectors? Could that be a spoiled spot? For example, pharma, IT, exporters.
Yeah, we are somewhat more cautious on those sectors, but that's only because of how bullish we are on domestic growth. There's nothing inherently specifically negative about them. But yes, we have to make space somewhere, and also defensive sectors within the market we would disfavor relative to financials, industrials, and consumer discretionary.
Jonathan, are you surprised with what a good year it's been? What a good year 2023 has been, from gold to Bitcoin, from AI-dominated stocks to emerging market equities. 2023 has been nothing short of a dream year, I guess.
Well, it has depended what asset class you buy. So yes, Japan equities FX hedge has done very well. That's been a key recommendation of ours, and India has done well. But if you look at Hong Kong or China or some other emerging markets, they are actually down for the year. So there's been very significant dispersion in performance this year.
So Jonathan, if inflation and interest rate tightening was the biggest talking point a year ago, 2 years ago, what do you think would be occupying everyone's mind space for 2024 at a global level?
Well, I don't think it's very sensible to invest on sort of broad concepts at a global level. As I just explained, the key to the performance in Asia this year has been to understand that Indian GDP growth was going to continue to power ahead and corporate earnings growth with it, whereas China, there was a lot of hopes around a China reopening trade this time a year ago, and that didn't pan out as people had expected. So I'm not a huge fan of investing in Asia based on broad concepts like global liquidity or the path of US interest rates. What's going on in Asia itself is far more important.
And final question, Jonathan. I know, we managed to squeeze this interview in between two meetings for you. In your assessment, 2024 and beyond, how much of money do you think could come back to emerging markets in general? Because if dollar is down, if interest rates are peaking out, if emerging market growth is superior, some would say that the money which moved from emerging markets to US, largely because of the interest rate cycle hike, that should also start reversing.
Well, our whole interview, we've talked about the fact that the emerging markets concept doesn't really work these days. We have highly divergent paths of GDP growth and earnings growth. And so in our coverage, Japan, which isn't an emerging market, has attracted about $70 billion of inflows. India, much less. But India's flows position on a go-forward basis is very bullish. And that's to do with Indian fundamentals, not US rate cycles. And likewise, outflows from other emerging markets, which are ongoing. There are quite large outflows ongoing from China. They're not driven by US interest rate cycles. They're driven by Chinese fundamentals.
Also true. And, I think we've revisited that point once again, because there is this whole, historic assumption with which macro allocators and at least a lot of our viewers think. So that's the reason why I guess, I revisited that point just to get clarity on that. Really appreciate your time, Jonathan.
Indeed.
When do we get to see you in India? Are you coming?
Great. I'm certainly be in India a couple of times next year for sure.
Well, look forward to host you in a studio that time. Thank you very much.
Great. Thank you. Bye-bye.
All right. Let's get a move on then and get in a corporate voice as well. Talk a little bit about the business outlook and PE's divesting part stake in 5-star business and whether or not a further sale is on the cards. Lakshmipati Dina Dayalan is the Chairman Managing Director, now joining us on the show. Good to have you on board. Thanks so much for taking time out and joining in. Now, let's just get to the crux of the matter, because despite being a very fundamentally strong business and seeing pretty steady performance, since the month of August, we've seen the stock under a bit of pressure, with several notable PE investors divesting their stake on Friday. I just want to understand how exactly we should be reading into this.
First of all, thank you for having me in your channel. So let me use some good time to explain about this background. To start with, I'm talking from a traditional NBFC point of view, not the startup lenders. Let me split the traditional lenders into two buckets. The first bucket are the older ones, which they have come on the back of the parental support, where the parents would have been in a different business and they wanted to get into lending space. That is one set of people. Another set of people like 5-star, we don't have any parental support. It's a standalone lending lender where we have to take two challenges when we start getting into the lending space. One is the business model. The business model where you want to enter. You can't do what the bigger traditional NBFCs are doing. You have to do something different and niche for yourself and find your foot that you are a perfect lender to this type of segment. That was the first challenge for 5-star, which we did very well. First 10 years we learned. The next 10 years we grew very stronger. Coming to the second point, the growth capital. Since we didn't have any parental support, the growth capital has to come from the private equity space. From 2014 onwards, we started to invite private equities who understood this business model, has had confidence on us. So that's where the names what you are going to refer, they started investing in 5-star from 2014 onwards. The first challenge, the business model challenge, was well scripted. And if you see, just we are completing the 1 year of our existence in this as a listed entity, our business model was taken up very clearly with the public investors as days goes, as months goes. Coming to the second point, yes, the private equity people who have come in have to liquidate at one time. We have to do it. But the good part is this, even in this part, 5-star has taken up in a very coordinated approach. If you see, pre-IPO, we had 70% of the capital from this private equity people. After the many block deals, what we have done, they have now dropped down to 38%. From 70% to 38% in a year, it's not an easy one. It's a well-planned, well-coordinated effort what the bankers, the selling shareholders, and the company, they keep doing in last 4 quarters. So the first challenge of business has been taken care very well, and the second challenge of the new traditional NBFCs like us has to take up is how are you going to liquidate the private equity players without affecting the valuation or the price of your stock. I think 5-star has balanced it very well. And what I'm hearing from my private equity people and the bankers are, I think the liquidity is done. For next 4 to 5 months, you will not see any liquidity coming to the market in 5-star.
Actually, we are focusing on who sold, but who's bought into when these large investors are selling? I'm just curious because we get the bulk deal data, but it's not very clear that who were the buyers. For a seller, there is a buyer, and for a buyer, there is a seller. So let's talk about the buyers.
I think all big names, perfect names who are going to be with us for next 5 to 7 years, the capitals of this world, the GSAMs of this world, Fidelities of this world, and mutual funds, HDFC mutual fund. I think all very marquee names they have got into in 5-star cap table in last 6 to 8 months. These are some big names, and particularly to be made to name more. We have White Oak, who backed us even in the IPO, were still backing us in the first block and even the second block.
Draw your attention to what we've heard from Reserve Bank of India in terms of unsecured loan. The category in which you are right now lending, some would also argue that it's largely an unsecured category also because 1 lakh loan, 2 lakh loan, 3 lakh loan. While you may not classify them as unsecured, but it's very difficult to recover from there because there's cost of recovery which would be difficult. So is this one category which Reserve Bank of India has flagged off, which they're calling unsecured loan, is something you also need to be worried about?
Absolutely no, Nikunj. First, let me go stage by stage. The RBI's worry from the media's report and the governor's speech is predominantly into non-traditional lending space, and that too into unsecured. Let me categorize it very, very well. Non-traditional lending space and unsecured loans. Whereas in 5-star, we lend to the business category, the MSMEs of this country, and housing end users of the middle and lower middle class, of the shopkeepers and the self-employed of this country. So very, very clear, this is not a new lending space. and unsecured. We don't lend to unsecured loans. So I clearly deny what you say. In last 20 years, we have seen many cycles, and this can't be a unliquidity done assets. We are able to liquidate assets. Both customers as well as company were able to do it. That's why you see the credit cost or the credit loss. It's at the industry best levels. So I don't think RBI will have no issues on lenders like Five Star who lend to the financial inclusion of this country at 3 lakh average ticket size.
Okay, so to understand the RBI communication, I'm repeating myself. What you are saying is that the impact on your lending and your customer profile is not going to be there, to put it very simple.
Yes, absolutely. Two things. We are lending for setting up a business. This is a long-term lending. This is not a short-term lending. This is not a working capital lending. We lend to a business guy who wants to set up his shop or who has borrowed from moneylender to set up his shop to repay the moneylender's debt. And we are lending it for a long period, around 7 years, and it's fully backed by collateral. That too, a collateral where the entire family members live in. So 95% of my collaterals are self-occupied residential property, and 5% is a collateral which can be a shop or a vacant land. So 100% secured loan given to a business community which has a long track record even during COVID times. I don't think RBI is worried about this. My guess is RBI is worried about short-term loans, unsecured loans, Jaldi loans, QR code loans. I think these are the points where RBI is more worried about.
Your exposure to unsecured loan as percentage of your total book?
0.
0. Okay, and you have no plans to make it grow that book because now others will be slowing down, so there's an opportunity for you.
Never, Nikunj, in last 20 years when I joined Five Star, my focus was only on a secured book because I have read the Indian mindset very well. It is not the lending underwriting is not for the good times. The underwriting should be for the bad times. So as far as the bad times concerned, if you are not backed by a emotionally strong asset, you will keep losing your capital.
All right, good to have you on board. Thank you so much for taking time out and joining in and giving us a lot more clarity on all of that news with respect to PE's selling stakes. 740, that's where the stock is at. We'll take a short break right here on the show. On the other side, we talk to the management of Mazagon Dock Shipbuilders on their major ONGC order win and lots more. Stay tuned.
Back with First Trades, right here on ET now. Let's just take stock of where the market has settled in at after what looked like a very, very quiet start. We're still pretty flat on the Nifty, but individual stocks, of course, continue to perk up. Look at the move on DLF. That stock is now up 3%. Godrej Properties, along with DLF, is also seeing a fresh move. A 2% traction is what you're seeing on Godrej Properties too. The RBL Bank, in continuation and follow through from last week, that continues to hold out too. A 3% move coming in there. And then PNB as well, which is going rock solid, 2.7% higher on the futures too. DRL, of course, is really bearing the brunt of those US FDA inspections. That stock continues to reel under pressure, 6% lower still. But the one stock which is also buzzing along with all these other buzzers has been Mazagon Dock. They've received order worth about 1145 crore rupees from ONGC. So let's discuss that as well as a lot more. We've got Commander Jasbir Singh, Director Submarine and Heavy Engineering at Mazagon Dock Shipbuilders, joining in on the show right now. Commander Singh, great to have you on ET now. Thank you so much for taking the time out and joining in. Tell us a little bit more about this ONGC order of 1145 crore rupees. The street, of course, is very excited. Your stock is holding up. When do the funds flow in? What is the timeline of this order? And what is the nature of this order, more importantly?
Yeah, good morning to you. I mean, MDL has been in the offshore business about 20 years ago. So it was one of our dreams to get back into this business. And now with this first order from ONGC, we can say we are back into it, in addition to what we build in terms of ships and submarines. So this is about 1145 crores business, and we are looking forward to having about, say, 5,000 crores per year in times to come. That is the minimum we are targeting.
Right. Did you say 5,000 crore rupees in terms of total order wins?
Total orders of the offshore business. You see, the Indian market is about $11 billion. And we are only, because we are just beginning, though sky is the limit, we are looking at a small pie out of this $11 billion dollars market to start off and go up to 5,000 crores to begin with. In about, say, 3 years' time, we hope to touch that target.
Okay, that's great to hear. The other thing I specifically wanted to ask is, with the ONGC order, now that you won the order, what is the order completion timeline? And when does this sum of 1145 crore rupees reflect on your books?
Yeah, this is about 6 months order. We have to complete the order in 6 months, this particular order. And there are more orders in the pipeline. And we are all geared up. You see, we have been building warships and submarines, and we are used to every kind of tough work that comes along with.
So you're geared up for more orders.
Yeah.
But let's just understand a little bit more about what some of the other big ticket non-submarine orders are on the cards, because you ended Q2 with an order backlog of about 37,500 odd crore rupees. So what is the outlook on those two parameters?
Yeah, so you see, in the total business order book, we have got 37,500 crores, as you rightly said. We also have new orders in the shipbuilding side, where we have got a cadet training ship of about 350 crores. In addition to that, we have an order of 14 FPVs from the Navy. We've got 6 OPVs from the Navy for 1,400 crores. These are few big orders that I'm talking of. In addition to that, the biggest order that we are now bidding, and we are submitting the bid today, is for 3 additional Scorpene submarines.
And how much is that worth?
So just to put you in perspective, the original order for 6 Scorpene submarines was 27,000 crores, which is for which 5 submarines have been delivered, and the 6th one is likely to be delivered in 2024.
Today, what you're submitting the bid for, that's an order worth 27,000 crores. How much?
No, the one which we are executing right now is 27,000 crores. But that was an order which we got about 17 years ago. So considering escalations, though the order value right now is not known, but one could calculate based on the escalations what would be the order for these 3 additional Scorpene submarines.
Is there any sort of uncertainty around the ordering timelines of some of the key Indian Navy procurement programs? Is that a worry?
It is no, there is no worry, because we are the best shipbuilders and the best submarine builders in the entire this particular area of the world. And we have shown that we have built these Scorpene submarines on our own. The last were built totally by Mazagon Dock. We have highly skilled personnel, both in shipbuilding and submarine building. And now that we have already started getting against competitive bidding, also we are getting orders now. And there is much more to come. I mean, there was 17 Alpha project that we are now delivering. We will be going ahead, and probably Navy would look at us for future frigates and destroyers.
You know, the other thing I also wanted to talk about is the export part of your business. Help us understand what kind of business do you now foresee going forward from UK, from Iran, from Mozambique, or for that matter, Singapore as well, like you have in the past?
You see, export is a very exciting market in all these areas. And we are in discussion with various countries, in fact, and trying to get the ships and submarines, both, though the sizes may vary. And that could be of a value which we can't fathom right now, but it could be thousands of crores that we would get in export business in terms of making hybrid ships, or they could be small ships, or they could be small submarines. So these are the orders that we are looking forward to, in addition to offshore business. In fact, the offshore business across the world is about $120 billion. And once we begin with this, executing these orders, there would be many more to come. And even if you look at, let's say, even 5% of the total pie of 120 crores, it's a huge value.
So in the next 5 years to
120
come,
billion. I correct myself, 120 billion.
we got that
dollars.
right.
Yeah.
In the next 5 years to come, what part of your business out of the three segments that you're currently operating in would be the largest in terms of revenue size?
In terms of 5 years you're looking at, it
Yes.
would be, we would be evenly poised on the submarine and shipbuilding side. We would be evenly poised, and we would be about, let's say, 30% on the offshore side by that time.
And do you think that more than the domestic market, exports could be larger for you or no?
Exports, we are trying to increase our exports to the best capabilities, and probably it could be about 10 to 15%.
Yeah, okay,
of the
currently at
total order
about
value in about, say, 3 years' time.
Okay, and you spoke of those mammoth orders from the Middle East in particular coming in, the export opportunity that you're looking at. Can you just give us a little more perspective as to how things have shaped up on that front? Are you already in talks? Are there any other geographies that you're looking at? By when will these export orders begin or conclude or reflect in your books?
Okay, so we are looking at, in fact, the entire all the sides of our country. We are looking at Southeast Asia for submarine building. We are looking at Europe for shipbuilding. We are looking at Middle East. We are looking at Africa. We are looking at South America for some repair orders. So there is, the export orders are plenty, which are there. It's only a matter of when we can tap them. I would say by the end of the next quarter, we probably would have our first good order from one of the countries for shipbuilding. So that would be the beginning while we try for other orders.
Good to know. By the end of next quarter, you'll have a major shipbuilding order from one of the export countries. Thanks so much for joining in. It's been a great year as well for shareholders of Masgao Dock, and you sound very optimistic as well about the future prospects. That's the stock price currently at 21.35, nothing short of a pretty fabulous run up. All right, let's get a move on then and take a very quick break. Be right back as we put the spotlight on the management of Orchid Chemicals and Pharma. Welcome back. Still tuned into First Trades, and for the markets at the current juncture, we're holding out. In fact, you've got the broader markets which are taking leadership today. The small cap index, by the way, is up about 0.7%. Just going to identify as well some of the movers within that pocket, because within the frontliners, it's just about flat as things stand. Take a look at the advanced decline ratio, and that breadth continues to be rather in favor of the gaining side. Strides Pharma, Century Ply, Credit Access, Yes Bank, DCB Bank, Rail Vikas Nigam. Those are some of your smart movers within the broader markets. Let's find out what the outlook is when it comes to key growth triggers with the management of Orchid Chemicals and Pharma. Manish Dhanuka is the managing director now joining in. Thanks so much for taking time out. Now, Mr. Dhanuka, the last 3 years, a lot has changed for the company. Financials, for instance, have improved quite significantly. You have a net cash on balance sheet now. Your products are doing well. What's the outlook over the next 3 years? What are going to be some of the key triggers?
Good morning, and thank you for having me. We've out big growth plans for Orchid Pharma. We have multiple optionalities working in our favor. Besides the existing business of the API that's thankfully doing well, we are developing ANDAs for the US market, and we should be in a position to file few ANDAs in the US for molecules which hopefully will not have too much competition. Then we have this PLI business. We have procured the PLI for a key intermediate of pharmaceuticals called 7-ACA. This intermediate is based on fermentation technology, and it is imported 100% from China as on today. and we are setting up a manufacturing facility to manufacture this product. So this will be other second optionality, which will generate growth with respect to revenue and the bottom line. Then we have recently signed a sub-licensing agreement with GARDP and Shionogi for a patented product of Shionogi, which is known as Sectorally. This is a very important molecule, not just for India, for the healthcare industry of the entire world. As you may have heard, these days the world is facing a very big challenge of antimicrobial resistance. Based on some estimates, almost 1.5 million people died due to antimicrobial resistant bacteria. And cefiderocol is a molecule which works very well against some of these resistant strains. So we have backed this, we have got this sub-license for manufacturing this product exclusively for 135 low-income countries, and Orchid would be manufacturing this for the entire world, including India. Then we are proud to say that Orchid has developed a new molecule. It is a combination antibiotic, and Orchid has filed for the clinical trials with the Indian regulatory authorities, and once this gets approved, this would become our proprietary molecule in India. Orchid is also entitled to get royalty on its worldwide sales, and we hope from the next financial year, the sales would start in the US and Europe, and that would bring a significant bottom line directly to the company.
I just want to probe upon that point that you just made in terms of the geography-wise breakup of your company. You drive close to about 4% revenue from North American markets, right? With the non-compete clause with the Hospira ended 2019, you're now allowed to re-enter the US markets. How do you expect this share to actually go up for you?
That's correct. We are now working with a number of customers who are selling formulations in the US market. And we hope to get approved with a number of players in the US market. They are now qualifying Orchid as the API source. So I'm hoping that the number should increase to maybe a high teens in terms of percentage of sales.
Right, and another growth trigger could be from your new chemical entity. Is that a lot of, do you see a lot of potential here with global launch being, successful?
Yeah, so the licensee known as Electra Therapeutics, it's a German company, and they are out licensing to various multinationals in the Europe, US, and it's already licensed in China. So Orchid is entitled to get royalty on the entire worldwide sales. So we are expecting the approvals to come through in 2024.
I just want to come back to, the point that you were earlier alluding to, the announcement of PLI investment of about almost 6,000 odd crore rupees for 7-ACA. Just wanted to understand, how will this backward integration help your margins to grow incrementally?
Yeah, so just a small correction, the investment would be 600 crores. So you see, 7-ACA is a fermentation-based intermediate, and this comes entirely from China. And this is the basis of largely, I would say, 80% of the antibiotics, the cephalosporin antibiotics, use 7-ACA as its starting material. So Orchid also has a significant portion of their procurement of 7-ACA from China. I think the in-house availability of 7-ACA will definitely de-risk us against the availability from imports. It will give us the cost advantage. And also we plan to manufacture downstream products from 7-ACA, which will give us an additional, I would say, value addition, and the gross margins should also increase from that.
Okay, fair enough. And the merger of the Dhanuka Lab and Orchid Pharma is underway. When is it expected to conclude, and how do you see your synergy benefits flowing in through the merger?
So the board has approved the merger. We should be filing for the stock exchanges approval soon. We are expecting the merger should go through in the next 1 year period. Both companies, Dhanuka Laboratories and Orchid Pharma, are in similar businesses. They make similar products. So besides the standard synergies of scale, like the procurement and sales, I feel that both companies have a pool of R&D scientists, and the pooling of this talent would definitely improve efficiencies in both the companies.
All right. And what about your cash position? How is that likely to be made stronger?
I'm happy to say that 3 years back when we started with a significant debt, today we are a debt-free company. But we do have significant investment plans. I think we are well set to not just utilize our QIP, cash that we are sitting on, but also generate enough cash to fund our expansion plans.
Great to then have you on the show, Manish. Thanks so much for taking the time out.
Thank you so much for having me.
Okay, let's move on now from Orchid Pharma. Let's address what's happening with the Brigade Group and let's try and get a better sense of where their business is headed. We've got with us Atul Goyal, the CFO, joining in on the show right now. Atul, hi, morning. Good to have you on ET now once again. Since the last time we spoke with you, a lot of activity has happened on the business development side for you. Talk to us about, your future launch pipeline. How's that shaping up? And when are these projects going to be launched?
Morning. The major purchases which we have done is Hyderabad and lot of purchase from Chennai also. So all this project which tantamounts to around 6 to 7,000 crores, and this all projects may be launched in Q1 next year or maybe Q2 next year. So we are very hopeful that if the market remains the same, all these project launches will be definitely be launched as early as possible. The market is right now very good, and as you see, we can see price rise, we can see the sale. So we should be very good going ahead from here.
Could you spell it out in numbers? What's the visibility you have on the trajectory of, revenues, margins, and profitability from these projects?
I'll just come to you about the launches. Launches is around 11.5 million is what we are seeing in next 4 quarters. And this 2 quarters, we may launch around 7 million or so. So launches are very, very, very firm, and they will be done accordingly. Revenue, as far as residential is concerned, it will be mainly on the registration of the properties. So it's very difficult to estimate. But overall, I think we should do a overall revenue at the year end of around 28 to 30,000, 3,000 crores also. 2,800 or 3,000 crores.
Yeah, those numbers. Recently, there was also a change in the SEZ norms, right? The government has now allowed floor-wise denotification of SEZ area. Since around 70% of your leasing portfolio is in SEZ projects, help me understand, how do you view this development?
Good development. Developers have been waiting for that for last 1 or 2 years. But for us, we already, majority of our SEZ leasing portfolio has been already leased. It's only 0.9 million, 0.7 million, which is there to be leased, and there also we have good global capability centers which are interested to take. But yes, this is a very good move. But one developer will have to do a calculation of cost-benefit analysis as to what is the vacancy in his SEZ area, what is the lease rent he can get up, because he'll end up paying whatever tax advantage he has taken from the government. So you will have to pay that. Then you will have to see what is the incremental rental you are getting, and then whether it makes sense in IRR. So all this will have to be calculated and see. Yes, of course, where for us, since our leasing vacancy is very small, I don't think so we may go for this.
I also wanted to get in the visibility on the real estate industry from you, because it's been a record 2022. We're closing in on 2023 with another record year. You think 2024 can beat what 2022 and 23 did? Tell me how some of your launches are performing in the key markets. What's the footfall expectation?
Right now euphoria is there, and markets are doing very well. In fact, if you see any research report, they say absorption is much more than the launches which are there by the companies. And of course, if you see in Bangalore especially, your stock is less than 10 months. So this says as to how much sales are going in, and you see the price increase. Your base price has changed. Your price increase in 9%. Increase year on year. So I think this market should stay there with the economic activity which is happening in the country and with the stable government, what it looks like for 2024. I think there is a good markets, the good real estate market which will be here, both in residential, maybe leasing in offices, and as well as hospitality. We are in all these sectors, and we are very confident that all these markets should do very, very well.
Okay, interesting. What about the residential segment as well, per se, because one has seen very strong pre-sales in Q2. What levels do you hope to end FY24 with? And, what is it that we can anticipate after you already surpassing 4,000 crore rupees in FY23? You think the FY24 number could be, say, above 5,000 crores?
Yeah, it can be. Definitely, it can be. We are very hopeful, and that is what we are budgeting for. But residential market is going to do well the way our new launches are there. In fact, there is a change in thought that whether you should launch, you should sell everything on one day, or you should stagger your sales with a price increase. So it is about the market. Real estate cycle has come after 7-8 years, and I think it should stay for next 4-5 years. That is what we think, but it's very difficult to estimate the market. But we are very hopeful that it should be very good.
Also highlight how the leasing and hospitality segments are shaping up for you, and what's the expectation, say, for the first half of the next fiscal?
Leasing is doing very, very well. I know SEZ has been laggards, but we didn't have much vacancy in SEZ, so we have not faced this issue. In non-SEZ, we don't have any vacancy, 100% in leased. So we are very hopeful with the going forward. Office market in Bangalore, Chennai, and Hyderabad should do well. And we think that though Hyderabad is bit problematic because of the over supply, but we think if it's a part of integrated development, we have a WTC license for Hyderabad. So we are very, very clear that we need to build one building which can be part of integrated development, where we have taken the space right now. If you see the research report, 16 million square feet is the absorption in leasing. So I don't think so. There has to be a challenge with SEZ problem solved with the new notification. I think leasing vertical should do very well. As per hospitality, we had a very tough time in COVID, and now hospitality is doing very well. We will be closing more than 400 crores of revenue this year with an EBITDA of 150 crores. So that is how hospitality is doing, and we see that this should grow more because international travel has not come at a pre-COVID level. So we think hospitality going forward should do very, very well.
Morning, Mr. Goyal Avan is well joining in on the discussion, and I wanted to get in a sense as to what the outlook is on the residential segment as well, because now that is a segment that is debt-free, and the debt on the office assets has remained steady. So are you comfortable with your current debt levels?
Yeah, we are definitely comfortable with the current level. We are 0.72 equity. Even if we have to raise some debt for the office vertical where we are going to do the construction, we are not averse, but definitely residential will try to keep it zero. If the sales continue like this, the cash flow will come in, and definitely we will like to keep it zero. Overall, if after the cash equivalent which is there in the company, we are at 2,500 crores of debt, which is very, very comfortable for us.
Okay, thank you for taking time out and giving us your growth projections as well as outlook. That's the word from the management of Brigade Enterprises. Projects worth 6,000 to 7,000 crores will be launched in Q1, Q2 next year, and they are looking at euphoria within the real estate market that is well placed. Tell you what, we'll take a very short breather right here on the show. Be right back.